So chapter 15 is all about shareholders' equity. So the transactions that are in shareholders' equity, that includes issuance of shares, that includes dividends, that includes other stuff linked to it. So first, what we're going to see is dividends. How do we split the dividends amount amongst preferred shares and common shares when there's an issuance? So first, we're going to do some theory. So for shares, each shares in a company has some basic rights. So some of the basic rights are that they share equally in profits and losses. So if you own 40% of the shares, you're going to earn 40% of the profit or loss. They also share equally in management. So your number of shares dictates how much voting power you have in the company. And each share shares proportionately in the corporate assets upon liquidation of the corporation. And in the Canadian office, the CBCA allows a corporation to assign this fourth right, that is the preemptive right, which is to share equally in any new issues of shares of the same class. So this is to protect each shareholders of their percentage of power in the company. So that, let's say that a shareholder has 100 shares and there's a total of 500 shares, then they own 20% of the company. But they can have the preemptive right that if there's a new issuance of 500 more shares, then they're going to still have 20% of the voting of the owning of the company. So they're going to have 200 shares. So they're going to have 20% still of the company. For some characteristics of common shares is that they represent the residual ownership interest of the company. They are the most, they can suffer the most, and they receive the most benefit of the company. What it means by that is that if there's a loss, they're not going to receive any dividends. Preferred dividends comes before common dividends, but common shares are not limited in the amount of dividends they're going to receive. So if there's a big dividend one year, the preferred shares are limited to a specific amount, and common shares can get all the rest. They can vote in annual meetings. And if the corporation only authorize one type of shares, it's going to be common shares. They don't have a preferred rank over the shares for dividend over preferred shares for dividend distribution or asset on wind up. They participate in the earnings and losses of the company and the appreciation and depreciation in the value of their ownership. Their common shares don't have to have a value. Basically, the value of the common shares are the net assets, so the total assets minus the total liabilities. And all the common shares are equally, they don't have any different characteristics. They all give the same thing. And they are retractable or redeemable upon dissolution of the company. Sorry guys, I kind of lost my voice today, so I'm going to be drinking a lot of water. For preferred shares, there are special classes of shares that have certain preferential rights. So they can be cumulative, convertible, callable, retractable, or participating. Cumulative, it means that if they're cumulative and in the past they didn't receive a dividend, then they can, and then the years that they're going to declare dividends, they're going to earn the dividends of all the past years that they haven't received yet, plus the dividend for that year. And that's before any distribution of dividends to the common shareholders. So these types of dividends, well, when they're not paid, they are called in arrears. And under common law, I don't know if Canadian is under common law, I'm not a lawyer, I don't remember. But if the charter of a company is silent about the cumulative feature, the preferred shares are most likely cumulative. Convertible preferred shares are preferred shares that can be converted into common shares at a specific time in a period of time. Basically, the reason why a company might have them is that, well, no, why a holder might have them is that there is some security about having a preferred share, because you're getting the dividend before anyone else, and you're not as touched when there's losses or if there's a wind up. But if the company generates a lot of profit, maybe you're going to want to switch to have common shares instead. They can be callable, so the issuing corporation can redeem them at any point at specified future dates and future prices. So the corporation issues those because they need the money and they don't want to issue any more. They don't want to get any more loans. They have a bad debt to equity ratio, so they prefer to just increase their equity instead. And when these are redeemed, any dividends in arrears must be paid if there's any. They can be retractable, so this is kind of like the reverse of this. It means that the holders of the shares can put or sell the shares to the company anytime they want, and they can sell them on the open market or back to the company. And participating preferred shares, it means that they participate at the same rate in dividends distribution as common shareholders. So let's say that there's a 5% preferred shares that are fully participating. You're going to give the 5% dividend to the preferred shares, then you get the 5% dividend to the common shareholders. Whatever is left in your dividends that you're going to pay, you're going to distribute it equally and proportionately to the preferred shares and common shareholders. And partially participating means that there's going to be some limits to what the preferred shareholders are going to get in the dividends. So they're going to get their 5% dividends, but then they might only participate up to 10% to what the common shareholders are getting, or in excess of 9% of what the common shareholders are getting. And as I mentioned, company issue preferred shares to avoid paying a loan, their debt to equity is too high, or to avoid treating debt on their financial statements. So for question 1, we're going to see how the dividends are distributed based on the features of preferred shares. So ABC Limited Ledger shows the following balances on December 31st, 2021. Preferred shares outstanding, 50,000 shares for $700,000. Common shares outstanding, 75,000 shares for $5 million. Retained earnings, $1.25 million. So the requirements, assuming that the directors decide to declare total dividends in amounts of $650,000, determine how much each class of shares should receive under each of the conditions that follow. Note that 2 years dividends are in arrears on the preferred shares, which pay a dividend of $1.12 per share. So let's see the requirements. For the first one is that the preferred shares are non-cumulative and non-participating. So that means that you're not going to pay the 2 years in arrears. You're just going to pay the dividend for the year. And that also means that whatever is left of the dividend amount to pay, you're going to all pay it to the common shareholders. So I like to make a little table just to have it clear next to me. It's pretty clear in this question, but sometimes the text can be confusing. So I prefer to put it all here, and then I can just use these numbers in my calculation. So I put the number of shares and the total value, and whichever amount of dividends you can get. And you can get it by dollars, like we did here, it's 1.12, or you can get it as a percentage, which we're going to calculate a little bit later. So preferred shares have 50,000 shares, and for a total value of $700,000. And common shares, it's 75,000 for $5 million. So the amount of dividends is 600, this amount here. All right, so now that that's set up, I'm gonna put down the years that are in arrears, even though we're not gonna use them for A, we're gonna use them for following requirements. So this is the preferred shares, the common shares. So first, you always calculate first the dividends for preferred shares. So it says here that they're non-cumulative, so you don't calculate 2019 or 2020. You don't care about those. 2021 is going to be $1.12 times the number of shares, which is 50,000, which gives us $50,000 for the preferred shares. And for the common shares, you get the rest. So it's 650,000 minus whatever we calculated for the preferred shares. So it gives us common shares, a dividend of 594,000. All right. So for B, now they're cumulative and non-participating. So I'm just going to copy this here. So what that means is that you're going to calculate the dividends for 2019, 2020, 2021, and then you're going to attribute the rest to the common shareholders. So it's just the same amount as earlier. So the 1.12 times 50,000 for 3 years. And then common shareholders get 650,000 minus this 2019, 2020, and 2021. So $482. For C, they are cumulative and fully participating. So for C, what you need to find is what is $1.12 in percentage. So how much is the percentage of dividends for the preferred shares? To find that, you find the dollar amount that they get each year, and you divide it by the total value of the preferred shares in the books. So for here, we know that each year they're going to get $56,000, and you divide it by $700,000. That gives us they're participating, they're getting a dividend of 8%. So what you're going to do is like here, they're cumulative, so you're getting the $56,000. And then you're going to want to find what is the 8% of dividends for common shareholders. So you do 8% times the total value, which I think I'm missing 0, but it's 5 million. So you calculate how much of the total dividends is already given. And how much is left to give. So it's your 650,000 minus this amount. And we're going to find the percentage of this amount against the total value of all your shares. So 82,000 divided by the sum of your 700,000 and your 5 million. So that gives us around 1%. So for preferred shares, you're going to find 1% times your total value of 700,000. And same for the common shareholders, it's 1% times 5 million. And then if you add everything up for 2021, preferred shareholders are going to get $178,000 in dividends, and common shareholders are going to get $471,000. So this is proportional to how many shares that are outstanding in the books. For D, it is the preferred shares are non-cumulative and are participating in distribution in excess of a 12% dividend rate on the common shareholders, common shares. So what you want to do, I'm going to copy again this here. is they're non-cumulative, so they're getting their 50,000. And then the preferred shares can participate in excess of a 12% dividend rate. So you want to find what is 12% for the common shareholders. So 12% times their 5 million. And then you need to check, is that more than the total dividends I'm giving out? So if you add these two up, we see that it's 6,000 more than what you're actually getting out in cash for dividends. So you're going to have to reduce your common shareholders dividends by $6,000. So it's going to be for 94. What was it? 594,000. So it gives us total dividends. If, let's say, instead of 650,000, let's say that instead it was 800,000, just so like you guys can see all the way through how you calculate it. Then what you're going to do, you still have your 56,000. Here you're going to have your 12% of the total value of your common shares. That leaves a dividend of 656,000. How much is left to give out? There's 144,000. What's the percentage? It's about 3%. So you do the percentage times the total value. And then same for the common shares, percentage times total value. And that should give us $800,000. Yeah, $800,000. Any questions? I feel like I went super fast through it, but if you guys have any questions on anything I calculated, just let me know. But yeah, that's pretty much it for the dividend preferences and how you attribute it. So for question 2, it's about the different types of transactions that you can have in equity. I'll go through it a little bit before getting into the problem. So for the issuance of shares, there's 3 types of issuance. There's the authorized shares, so how much a company is able to issue. You never use this number in a question. You're not recording it. It's just the limit that the share can issue, but it doesn't mean anything for us in account. No, it doesn't mean anything, but you're not using it for a transaction. There is the issued shares, so how many shares the company issued to the market. It's smaller than the number of authorized shares. And then the outstanding shares is how many shares are held by shareholders, which is smaller than the issued. So when you're doing the transaction, you're looking at the issued shares. And it's basically cash, the amount that you're getting, and common shares, how much are you, what is the value of the shares that you're issuing. Shares can be issued with other securities. So 2 or more classes of securities are issued for a single payment or lump sum. I'm realizing that my example is not really it, but that's okay. IFRS, basically, when you're doing that type of transaction, you're going to look at the fair value of the asset, well, of the good and service that you're getting, and if it can be reasonably estimated. If it can, you're going to use that as your price for your equity, well, your common shares. And if it cannot be reasonably estimated, then you're going to use the fair value of the equity to value everything. If the fair value is given by management or the board of directors, it's not reliable. It's not the fair value of actually the asset. There can be some bias. You take the fair value of the shares. You always take the market fair value when you're doing these type of transaction. I'm gonna skip, like, forget about this example. It's not good. And then for ASPE, you use the most reliable of the fair value of the goods and services you're getting or the equity you're issuing. For the cost of issuing shares, what you're doing, you're reducing share capital. So you're debiting your common share, preferred share, share capital, and then you credit your cash or whatever was used to pay. For when companies buy back their own shares, they can do that because they want to increase their earnings per shares or return on equity. They have an employee benefit plan with issuance of shares. There can be many reasons why they're doing that. In Canada, there's no treasury shares. If you saw Income 308, that doesn't apply to Canada. So all the repurchased shares needs to be canceled. And if there's a limit on the authorized number of shares, then the shares are restored and they're just put as unissued. When they are bought back, sorry, the price paid can be different than what you have in your books. So your gain or your loss is going to go in equity directly instead of going in your income statement. So if the market price is greater than your book value for the shares, and the acquisition cost is distributed first your share capital, so it equals the book value that you have. Then any excess to contributed surplus repurchases for the same class of shares. So this is if there was a cancellation of shares where the book value was greater than the market value. It needs to be the same class. So if you're buying back common shares, but you have repurchased preferred shares, you can't use the contributed surplus for it. You go to the next step. So after that, you put it at zero, your account. And if you still have some left over, then you put it to contributed surplus and any financial security that was linked to your class of shares, so options, warrants. And that is proportional to the number of shares you have in your book. So if you're buying back 200 shares, but you have 1,000 shares issued, then you're going to do 200 divided by 1,000 times whatever amount you have in that contributed surplus. And then once you put that to zero, that account to zero, then any excess debit the retained earnings. If you don't have contributed surplus repurchase, you go to the next one. And if you don't have contributed surplus, sorry, you go to the retained earnings. If the market cost is lower than your book value, oh my God, I'm sorry. I'm gonna get through it. Then it's the same as here. You put it as you debit your share capital for the same price as when it was issued, and then anything that's left over goes into contributed surplus repurchases. So you can use it whenever this situation arises. For cash dividends, when dividends declared, dividends payable, and when the dividend is paid, dividends payable to cash. They might talk about a date of record. That's when in between the two, you want to look at all the list of shareholders, and you have to give that before you pay any dividends. You don't have any transaction on that date. Dividends in kind are dividends that are payable in a corporation assets other than cash. So they're measured at the fair value of the asset given up, unless it says that it cannot, the fair value is not reliable. In that case, then you use a carrying value, so the book value of the assets that are transferred, and there's no gain or loss if you use a book value. The stock dividends, basically declared amount of dividend must be added to the share capital account. So at the date of declaration, it's dividends common shares. And if the dividend is declared before it's distributed, then it's going to be dividends, stock dividends disputable, and you're going to debit that account when you issue the common shares. So for question 2, we're going to see a lot of these transactions while we're doing it. So ABC Limited reported the following amounts in the shareholders' equity section of its December 31st, 2020 statement of financial position. Preferred shares, $5 dividend. There's 15,000 shares authorized, 5,000 issued, and the total book value is 150,000. Common shares, unlimited authorized, 45,000 issued. They have $725,000 in the books. There's a contributed surplus repurchase for 5,000, contributed surplus options for 15,000, and retained earnings of 450,000. During 2021, the company had the following transactions that affect shareholders' equity. And basically, we have to do the transaction for all of these events. So the first transaction was that they paid the annual 2020 $5 per share dividend on preferred shares and a $2 per share dividend on common shares. These dividends had been declared on December 31st, 2020. So on December 31st, 2020, they didn't issue the shares. They only recorded dividends and put anything in the dividends payable. So you want to reverse that and issue your shares. So it's going to be dividends payable as a debit. And your credit is going to be cash. Sorry, I think I misspoke here, but you're going to pay them. The amount is going to be $5 per 5,000 preferred shares plus $2 per 45,000 common shares. For the second is that they purchased 7,500 shares of its own outstanding common shares for $21 per share and canceled them. So this is what I was talking about. First, we're going to find what is the book value of all the shares that were purchased. So the book value is $725,000 here, divided by 45,000. So you get the unit price times 7,500 shares that are repurchased. So that's the book value. And the market value is 7,500 times 21. So your market value is greater than your book value. So you're going to go here and do all these steps. So first, you're going to debit your common share account for your book value. Then you're going to go look in your accounts. Do I have a contributed surplus repurchases? Yes, I do, for $5,000. So I'm going to put everything as a debit. And then does this equal my market value? Not yet. I'm going to continue. Do I have a contributed surplus options? Yes, I do. So I'm going to put it down. And like I said, this amount is proportionate to the number of shares that you cancel. So you're going to do 7,500 divided by 45,000 issued. And you time it by the book value of your contributed surplus. So times 15,000. And then that doesn't equal yet your market value. So you're going to put the difference in your retained earnings. And then here it's going to be cash, because that's what we paid cash to buy back their shares. So the effect of this transaction, it means that your number of shares at the beginning were 45,000, and then you bought them back. So now you have in your books 37,500 shares. For the third one is that they issued 450 preferred shares at $30 per share. At the beginning of the year, there was a cost of issuance of $500. So we're going to record the issuance and the cost in the same transaction. So this is going to be cash, because again, cash of 450 times $3 minus your $500 of cost issuance, because it reduces the value, and then your preferred shares for $13,000 also. Then the fourth one, yeah. I see someone has a question.
It's actually a quick question. So sorry, I'm losing my words. So for question 2, for a second transaction, I had a similar question, and basically for the information under preferred shares and common shares, it said certain amount is authorized, but it didn't specify how much was issued. So if it doesn't specify how much is issued, am I supposed to assume that the amount authorized is also issued, or is it like a special trick that I need to use or something?
That's a good question. My instinct would tell me to just assume that it's they issued all that was authorized. So yeah, for example here, I would take the 15,000 here for the preferred shares. But
yeah, okay.
You're right in saying that maybe they issued nothing, you know?
And what if they issued nothing? Do you, what is it again? I kind of forgot, but for the cancel.
Yeah, I mean, if they issue nothing, they cannot cancel anything, right?
Yeah.
So they can't cancel nothing that hasn't been issued. So yeah, I would take the authorized amount in that case.
Because well, just for clarification, when you calculate repurchase and then cancellation, the amount cash that you get, it's pretty straightforward. So you just it's a credit to cash and that's it. But the things that you debit, I'm not 100% sure what I'm supposed to debit.
Oh, okay. Yeah, I can go over them again. So there's kind of if there's the accounts that I'm going to talk about, you're going to use them in like 1, 2, 3, 4 here.
Okay.
So first, you always put first your common share account as a debit for your book value. Then here, you kind of look, okay, do I have a contributed surplus repurchase account? If I do, I debit this first for either the total amount that you have in your books, that account, or for any differences between your book value and your market value. So whatever you put in your common shares and your cash account, if it's lower than what you have in your book. You're still following? Yeah? Okay. So if you don't have it, or if you're done attributing it to the contributed surplus repurchase, then you look if you have the contributed surplus options. And you're going to use that account for the balance, or either you do the proportion calculation that we did. And then whatever is left in the difference, you debit it to your retained earnings. So let's say you didn't have a contributed surplus option warrants account here, then you would have debited your common shares for the amount that we did. You would have debited your $5,000 here for the contributed surplus repurchase, and you would have put the difference in retained earnings because you didn't have the options.
Okay, got it.
Got it?
Yeah.
Perfect.
Thank you.
No problem. All right, so I think I was done with requirement 3 because So if they only give you, like if they say that they didn't issue anything and they just give you that they had a cost of issuance, then you would have done preferred shares to cash for $500. It's just I did it all in one transaction because it was easier. But this is like this is like the complete transaction, or you can do it in 2 times, doing cash and preferred shares for 15,500, 15,500. So you can either do these 2 transactions or just do that one transaction. They do the same thing. For the 4th requirement, they declared a 15% stock dividend on the outstanding common shares at their fair value when the shares were selling for $24 per share. So first, what you want to find is, no, I'm getting confused with like the EPS. What you're going to do is you're going to have your dividends, and you're going to have your, did they pay it yet? No, so they're going to have the stock dividends distributable. So they didn't issue the shares yet. And that amount is going to be 24. No, sorry, I'm getting mixed up. It's 15% of your outstanding balance of shares, which is 37,500. We calculated earlier after the repurchase, and then times $24. And it's the same amount here. For the payment, which I think is the next transaction, you're gonna debit your stock dividends distributable, and you're gonna credit cash the same amounts. And then the last transaction is that they declared annual 2021 $5 per share dividend on preferred shares and a $1.75 per share dividend on common shares. These dividends are payable in 2022. So you're going to have your dividends payable because they haven't paid it yet. And the amount is going to be $5 times, we didn't change anything to the numbers of preferred shares, right? Yes, we did. We issued the 450 more, so it's going to be 5,000 plus 450. And then your common shares are your 37,500 times your stock dividend here of 15%. And then times $1.75 per share. Just want to check if I did the math right. 1.15. Yep. Any questions? All right. So for question 3, it's about a subscription basis. Basically, what happens is that a lot of people want to buy your shares, but they don't want to pay all the amount up front. So you're like, okay, well, you're going to pay me in installments, and I'm not going to issue any shares until I receive all the money. So the company is going to put the payments in reserves, and when they receive the final payment, then they're going to convert those payments into shares. When there's a contract, you set up a subscription and receivable account, and you credit a common share subscribe. Your cash, when you debit your cash when you receive the payment, and you reduce your subscription receivable. And after the final payment, when you issue the shares, you debit your common shares subscribed, and you credit your common shares to issue them. What might happen sometimes is that the subscribers of the shares might not pay after like the first or second payment. So there's 3 options the company might do. They might forfeit the amount. So they're like, well, too bad for you. I'm going to take all the money, and I'm not giving back anything to you. And that amount that they already paid is going to go in contributed surplus. They might refund the money. So it goes back into cash. And then they might also do a partial share issue. So whatever amount of money they paid, then they're going to issue shares for that amount. So normally what happens for a default, you debit your common shares subscribe account for the amount that they paid. And then depending on the situation here, you credit your contributed surplus, cash, or common shares. So For question 3, ABC Limited choose to sell shares through a subscription basis. The offering was 65,000 shares at $45 a share. The terms of the subscription were 25% down, 35% due a month after, and the balance due at the end of 6 months. All shares were subscribed for during the offering period. First requirement, prepare the journal entries for the subscription contract, the payments, and the issuance after the final payments. So first, we're going to do the first transaction I put here. So for the contract, it's subscription, receivables, common share subscribed. And the amount is going to be 65,000 shares times $45. I check if I'm doing my math right because I've been doing some math errors. Yeah. All right. Same amount. Then, so this is contract. Then they do the first payment the same day that they are subscribed. So they receive cash and they're gonna credit their subscription receivable. And it is for 25% of the amount that we calculated for the contract. For the second payment, it's going to be exactly the same, but it's going to be 35% times the amount here. And then the final payment is going to be, what's 35 plus 25 is 60%. So it's 40% the final payment. And then if I sum all of these, it should equal the same thing. All right, that works. And then they issue the shares. So it's going to be common shares, subscribe to common shares for the same amount as the contract here. So now we've done all of this for A. For B, for the second payment, subscriber to 12,000 shares failed to make a payment. Prepare the journal entries for the second payment and following transactions if the company returned the amount paid by the subscribers, should the amount paid as forfeited, or the company issue shares to the subscriber. So basically the three situations we had here. So first, we're going to do they pay them back. So they're going to have the common shares subscribe. Right? The company returned the amount paid, yeah. Yeah. And then they're going to have the subscription receivable because not all the payments have been done, and the cash amount that they're going to pay. So subscribe, you're going to take 12,000 shares that were defaulted divided by the total amount of shares, so 65,000 times the total amount that we had in the account. Your subscription receivable, so this is for the second payment. So they only paid the first payment. So we're going to do again 12,000 divided by 65,000 times the amount that you have for your first payment. And then your cash amount, no. Your cash amount is this. So your cash amount is the first payment that they do, and then your receivable is the balance that's left. You can just do the difference. Oh my God, I'm sorry, guys. Right, this minus this, or you can find this by doing 12,000 divided by 65,000 times your subscription receivable minus your first payment. Should give the same thing. Finger cost, yes. All right. And then for the following transaction, you're going to have your second payment. So this is going to be cash, subscription receivable, and then it's going to be your 12,000 divided by 65,000 times your amount for your second payment. Just going to put here second payment. have your third payment. Again, 12,000 divided by 65,000 times the amount for your third payment. And then for your common share subscribe, well, for your issuance of shares, you're going to debit your common share subscribe to common shares, and it is going to be 12,000 divided by 65,000 times the amount here. Oh no, sorry. Sorry, I mixed myself up. You're not going to use the 12,000 here in your calculation because this is as if the 12th person that failed were actually the only ones that were making the payment. So you're going to actually do 65,000 minus 12,000, which is 53,000 on 65,000. Hope I didn't mix you guys up. Yeah. So basically, what are amounts that were paid by the people that didn't forfeit on their shares? You can also find all of these by retiring, well, taking out the amounts that you've put here from your balance of account. So let's say you're contributed your common shares subscribe before the forfeit of the 12,000 shares. It had a balance of 2.9 million, and then the forfeit was minus 540,000. So now you have a balance of 2.3 million. So then here, what you would have done, you would have used your same, well, here it would have just been this amount, right? That's what you're issuing. Then you do the same thing for your subscription and receivable account to find what's the balance after they forfeit their shares, and you use a percentage for the following payments. For the second is that they treat the amount paid as forfeited. So I'm just going to copy this here. And then instead of cash here, it's going to be contributed surplus for the same amounts. And then the transaction here for the second, third, and issuance of shares are the same. And then for the third requirement, the company issues shares to the subscribers. So you take back again, same transaction. And then instead of contributed surplus, you're going to put your share count, which is common shares. If they subscribe to preferred shares, then you would have put preferred shares here instead. So basically, instead of getting, they're only getting the amount of shares that they paid for with their first payment. And that's about it for chapter 15. I like this chapter. I find it it's kind of like just solving puzzles, especially with the dividend preferences. And then we're going into chapter 17 with earnings per share. So earnings per share helps common shareholders to see what will they earn from their investment on a share basis. So let's say I have 100 shares, the company earnings per share is $1.5 per share. Then I know that I'm gonna probably get in dividends around $150. The calculation for earnings per share is the net income minus the preferred share dividends, because you only want the income that's available to common shareholders, divided by the weighted average of common shares. So it's looking at the actual earnings and the actual number of common shares outstanding. So this number is common shareholders only. You're not looking at preferred shareholders. IFRS requires for EPS that that they must be shown for all the periods that are presented. So if in your financial statement, you're using the previous years as a comparison, then you must also put your EPS for the previous year. If there's a stock dividend or a split, all the per share amounts of prior period earnings, so all your EPS amounts from previous periods, it needs to be restated to reflect what the stock dividend or the split. And then when the results of operations of a prior period has been restated, the corresponding EPS data should also be restated, and that's going to be shown in the year of restatement. And then if 1 year they decide to put the diluted EPS, then they have to do it forever. They must always include the diluted EPS in their financial statements. If the preferred shares are cumulative, but they didn't receive a dividend during the year, then they still, in the calculation here, you still have to subtract the dividend that the shareholders are allowed, because eventually they're going to get it. So it's not income that's available to the common shareholders. First, stock dividend splits and reverse split. The reason why we restate all the prior numbers of shares before whatever happened is because the percentage of ownership of all the common shareholders when this happened doesn't change. So let's say you have a stock dividend that only impacts the current shareholders, right? All the shareholders are going to get the same stock dividend or stock split or whatever. So it doesn't change the percentage of interest. And because of that, you want to reflect also all the transaction in the past to reflect that stock dividend and stock split. For issuance, because if you don't, it's going to look at an issuance of shares, and that's going to look like as if the percentage of ownership of each shareholders has diminished instead of just stayed the same. If a stock dividend or split or reverse split happens after year end, but before the final statements are released, then you need to update your weighted average common shares to reflect what happened, and for every year prior. And basically, it helps with the comparability with the next years in progress. And finally, if there's discontinued operation, then you present the EPS for continuing and discontinued operations. So let's look at question 4. On January 1st, 2021, ABC Limited has 600,000 common shares outstanding. During 2021, it had the following transaction that affected the common share account. So on February 1st, they issued 200,000 shares. April 1st, they issued a 2-for-1 stock split. May 1st, they acquired 350 common shares and retired them. On August 1st, they issued a 10% stock dividend. And on October 1st, it issued 45,000 shares. And the company year end is December 31st. So what they're asking you first to calculate is the weighted average number of shares outstanding as at December 31st, 2021. So basically, you want to find after all of these transactions, like how many, on average, how many shares were there during the year for that company. So I like to do a little table, and I think also your teacher showed you by doing a little table. So I put what to put the event of what happened, the date that it happened, the number of common shares, the time that it stayed that amount, any factor for a split or a dividend, a stock dividend, and then at the end, your weighted average common shares. So we're going to look first. You have to put your beginning balance. So on January 1st, you had 600,000 shares. And I'm going to fill the time and split div as I go, pretty much, and then weighted average common shares as I go to or at the end. And then on February 1st, you issue, well, the company issued 200 shares, so that means that there's 200,000 shares more. So in total, they have 800,000 shares. So for the time here, you only had 600,000 shares for 1 month out of the year, right? So I'm gonna put 1 divided by 12. And then on April 1st, they issued a 2-for-1 stock split. That means that each shares gives you 2 shares. So they doubled the amount of shares that were in the books. The time, well, I'm gonna do that after. Now, it didn't issue new shares, it didn't do anything. So you're gonna have to restate your past balance to reflect the split that happened here. So in the factors here, you're gonna put 2 and 2 for the 2 previous transactions. And for the time for February 1st, it was 2 months out of the 12 at 800,000. Then on May 1st, they acquired, well, they retired 350,000 shares. So that means that there's less shares. So it's going to be 1.6 million minus the 350,000 shares that they retired. So now they have a balance of 1.25 million. And for the time of between the two, it's only 1 month. Then on August 1st, they issued a 10% stock dividend. So that means that now they have 10% more shares. So you're going to do 1.1 times the amount of shares that they had previously. And then since you didn't issue new shares, you just increase the number of shares for everyone. You're going to have to come here and add your 1.1. 1.1 for all the previous transactions. Here, since you already had the 2-for-1 thing, you're going to time it by your 1.1. So you want to add both effects. And then the time is going to be May, June, July, right? 3 months. And then on October 1st, they issued 45,000 shares. So this amount plus 45,000. So here it's only 2 months. And here it's going to be 3 months again. I like to make sure that the time, the column here is equal to 1 for 1 year, which it does, which means I'm good. Now to find the weighted average common shares, you time your number of common shares times your time times your split div column. And you do that for all the transactions that occurred for the shares. Of course, you can't time by 0. All right. And then you sum them together, and that's going to be what you're going to use in your calculation for your weighted average common shares. So on average, during the year, there was 1.4 million shares issued. Well, outstanding, sorry. All right, so that's it for A. For B, assume that ABC Limited earned net income of $4.75 million during 2021. So net income, 4.75 million. In addition, it had 25,000 of 6% $75 par non-convertible, non-cumulative preferred shares outstanding for the entire year. That's a mouthful. And no dividends were declared or paid during 2021. Calculate EPS using the weighted average common shares from A. So dividend from preferred shares. Is there any for the preferred shares? I'm gonna say no, that's my guts, because they're non-cumulative. So that means that any share dividends that weren't paid, we don't care in the previous years, and no dividends were paid or declared during the year. So you're gonna put 0. And then your weighted average common shares is the amount that we found here. So your EPS is gonna be your 4.75 million minus your dividends, which is 0, divided by 1.477 million. So your EPS is $3.21 per share. So that's what a common shareholder can get back from its investment. For C, I assume the same facts as in part B, except that the preferred shares were cumulative. Calculate EPS for 2021. I kind of like forgot to put some things here, but let's assume that it's in arrears for 1 year and that the company only paid dividends to cover for their year in arrear. Because if not, it's going to be the same EPS. Oh no. Forget about what I said. It's 1 year, it's still 1 year in arrears, but they still didn't pay any dividends. So there's going to be net income. It's going to be the same. They're going to have your dividend preferred shares. It's 1 year in arrears. And you also have to take into consideration, no, it's not 1 year in arrears. Oh my God. Forget, okay. Delete everything I just said about requirement C. It's the same fact as in B, but the preferred shares are cumulative. They're not in arrears and no dividends were declared. All right, so I'm gonna copy this. I'm gonna put your net income, which is the same, 4.75 million. Your dividend preferred shares, none were declared, but you still have to take into account, since they were cumulative, that eventually that amount is going to be paid. So you still have to calculate it as if it was paid for the year. So to calculate it, it's going to be your $25,000 shares that were outstanding times their par value times the 6% dividends. And then your weighted average common shares is the same amount as earlier. So your basic EPS is going to be net income minus your dividends divided by your weighted average common shares. It's going to be 3.14. So just be on the lookout when you're doing these type of exercises for basic EPS or even diluted EPS to look if the preferred shares are cumulative or not, because you see, I even got confused and I did that exercise. I like made it up. So just be on the lookout on exams. It could be a trick question. So for D, assume the same fact as in part B, except that net income included a loss from discontinued operation of $350,000 net of applicable income tax. Calculate EPS for 2021. So what you want to calculate, you want to calculate your EPS from continuing operations and from discontinued operations, and then your total. I'm going to put your net income here. If there's any dividends, with the average common shares, and then your EPS. So your total net income was 4.75 million. It doesn't change. It included a loss of $350,000 from discontinued operation. And then you need to find what is my income from continuing operation. So it's going to be your 4.75 million plus your loss. So your net income is 5.1 million. there's no preferred shares dividends because we're looking at B and they were non-cumulative. And then your weighted average of common shares is the same as earlier. So your EPS for your continuing operation is the net income minus preferred share dividends divided by your weighted average common shares. And you do the same for all of these. So what you need to be on the lookout for when you're doing these is that if you already calculated like your basic EPS without your loss, then your total here should be equal to what you had calculated previously. So your total is equal to your total here. Should be the same number. For E, for this part only, assume that a 3-for-1 split occurred on February 1st, 2022, prior to the release of the 2021 financial statements. How many shares will be used to calculate EPS for 2021? So as I mentioned earlier, you have to restate your weighted average, your number of weighted average common shares for the year if any split occurred, any stock dividend occurred. So what you're going to do is you're going to do your weighted average common shares before the stock split. And then 3-for-1 means that for each 1 shares that a shareholder had, they don't have 3. So it's going to be times 3. So they're going to put, instead of the 1.477 million, they're going to put the 4,433,000 for their calculation of EPS. And then for F, for this part only, assume that a 10% stock dividend occurred in 2023 prior to the release of the 2022 financial statements. How many shares would be shown for comparative purposes for 2021? So the same as in here, except that now instead of being 2021 financial statements, it's the 2022, but you still need to restate them to reflect the 10% stock dividend. So this is for this part only. So I'm not going to take into consideration the 3-for-1 split that was in part E. So I'm going to take the number of shares that we calculated before the stock dividends times 1.1 to reflect the stock dividend. And that gives us a 1.6 million number of shares that they're going to use for their 2022 financial statements. All right, so that's it for basic EPS. I think we went through like any possible situation. For diluted EPS, this happens while we're calculating it is that the company might have, or people might have financial assets, financial instruments that could have a negative effect on the common shareholders of the company. What I mean by that is that a convertible bond, for example, that they can switch their bond to common shares at any time that they want. What's going to happen is that there's going to be more shares, and that might decrease the EPS for the common shareholders. So they might have less than what they expected with the numbers that were in the financial statements. So the diluted EPS is a what if calculation that takes into account any financial instrument that can have a negative impact on the basic EPS. There's 3. There's the call options or the warrants. They're treated the same way. There's the convertible preferred shares, and there's the convertible bonds. So this informs the user of the worst case scenario, like what's the lowest that their earnings per share can get to if like everyone exercises the right all at once. So what you're going to do first, you want to calculate the incremental EPS effect of each of the financial instruments. If the incremental EPS is lower than the basic EPS, then that financial instrument might be dilutive, and you might want to include in your diluted EPS. You do that for each of your financial instruments, and you rank them on which one is the lower. So rank 1 is going to be the lowest. So the lowest EPS, the one that's furthest away negatively from your basic EPS, Your second one is the second worst, etc. And then you add them to the basic EPS following that rank. So you're going to have your basic EPS first, then you're going to add the incremental EPS of your rank 1, and you're going to continue until you're done with all your ranks. As you add them, you have to be on the lookout for any incremental EPS that will increase whatever EPS you calculated before. So what I mean by that is, let's say that you're on rank 2, your diluted EPS as of right now is like 2.5. And then you do your rank 3, and when you add it, it increases your diluted EPS to 2.7. So instead of being 2.5, it's now 2.7. So it is giving it's positive, right? It's affecting your EPS positively. So that means that that financial instrument is anti-dilutive, and it shouldn't be included in your EPS, your dilutive EPS. So your dilutive EPS is going to be whatever EPS that you calculated for your rank 2, and any ranks after that, you just ignore them and you don't include them, because from your rank 3, then it's just going to go up. Hope that makes sense. I feel like I said EPS a lot. So I'm going to put this bigger. To find the incremental EPS, you calculate the income effect, the share effect, and then from these two, you calculate the incremental EPS. So for convertible bonds, the income effect is going to be the interest expense that you're not paying, net of tax. So normally on bonds, you're paying interest at each period. Yeah, I think someone has a question.
Yeah, just a question. If the convertible bonds were semi-annual, would this affect how we solve the question, or does it not affect the diluted EPS?
It would affect the question if they convert them like in the middle of the year. No, sorry. For your question, no, it doesn't affect them. You're just going to use your total interest expense for the year. I was thinking, yeah. I was thinking if you convert them in the middle of the year, but that doesn't matter for this.
Okay.
Is it the whole year?
Okay, thank you.
No problem. So yeah. So you find the interest net of tax. So that's going to increase your net income because you're not paying it. And then the share effect is the number of bonds times the number of shares. And your incremental EPS is your income effect divided by your share effect. For preferred shares, is your income effect is that you're not paying those dividends anymore. So you're going to find the percent of dividends times the number of preferred shares times their par value. So whatever amount of preferred share dividends that you would have paid. And share effect is number of preferred shares times number of common shares. For the stock options and warrants, there's no income effect. There's only a share effect. And the share effect is how many more shares was I able to buy with the price that I got on my stock options or warrants. So how you're going to find that is whatever number of shares that were on your option minus the same amount of shares times the price on the option or warrants divided by the market price. Basically, I'm going to do the calculation later, like all spread out. It will make more sense. So yeah, that's it for the theory. Also, the call options, stock option warrants are the most dilutive. They're always going to equal 0 because your income effect is 0. So this should always be rank 1. That doesn't work. That's not working. All right. Sorry, I'm having some technological difficulties here. All right, so question 5. ABC Limited reported net income for the year ended December 31st, 2021 of $1 million, and there were 250,000 common shares outstanding throughout the year. The average market price for common shares for the entire fiscal year was $50. ABC Limited tax rate was 40% for 2021. ABC Limited also has the following securities outstanding during 2021. 5% convertible bonds issued at par for $15 million. Each $1,000 bond is convertible into 10 common shares. Options to buy 75,000 common shares at $35 per shares, and 25,000, 5%, $100 per value convertible preferred shares. Each preferred shares is convertible into 2 common shares. So first, you're going to want to calculate your basic EPS. And even if you know it's a diluted EPS question, you always want to calculate that first. So your net income, your preferred shares, dividends, your weighted average common shares, and then your basic EPS. So it says that the net income for the year was $1 million. All right, preferred share dividends. It says here that the dividends were convertible. No. Per value convertible preferred shares. Do they say that they're cumulative? Doesn't say anything about if they're cumulative or not. I'm just gonna assume that they are for the purposes of the question, but if they say non-cumulative, here you would pick 0. So to calculate them, it's 5%, to calculate dividends, 5% times 25,000 shares times $100. And then your weighted average common shares are 250,000. So your basic EPS is 1 million minus 125,000 divided by 250,000. All right, and then for the diluted EPS, you're going to compare everything to your 3.5 here. So if the incremental EPS that we're going to calculate for each of them is lower than 3.5, then it might dilute it. So what I'm going to put here, I'm going to put the income effect, the share effect, the incremental EPS, and then the rank. The rank, you're going to find it last. So once you calculated all your incremental EPS, so this you do it last. So first we have the convertible bonds. So you want to find the income effect, so the interest amount net of tax. So your tax rate is 40%. So 1 minus 4.4 times your interest. So it's 15 million. That's the par value times 5%. And then your share effect, there's how many bonds? There's 15 millions divided by 1,000. And then they're convertible into 10 common shares. So your incremental EPS is of 3. So that's lower than 3.5, right? So it is dilutive, maybe. We don't know yet. We're going to see. Then you have your call option. No income effect. Share effect, how many more share was I able to buy than if I bought it with the market price? So I put the calculation here, but how I do it in my head is basically I find like the dollar value, so $75,000 common shares times $35. So that gives me 2.6 million around. And then basically the calculation is this times your market price is equal to 2,625. So that's the calculation that we did here. It's exactly the same. It's just that I'm putting it longer. Maybe it's going to make more sense like this. So basically what you want to do is this amount divided by the market price of the shares. So if you bought them for $50, you would have been able to buy 52,500, but you actually bought 75,000, right? So how many more shares were you able to buy? So it's 75,000 minus the 52,500 that we just found. So you were able to buy 22,500 more shares. So that's what I'm going to put here in the share effect. And the incremental EPS is going to be 0. So this is probably dilutive, most likely dilutive. And then finally, you have your convertible preferred shares. So we want to find first the dividend amount that we're not going to be paying if we convert them. So it's going to be 25,000 times 100 times 5%. And the share effect is going to be 25,000. And we can convert them into 2 common shares. So the incremental EPS is 125,000 divided by 50,000. So that's 2.5. So this also might be dilutive because it reduces, it's lower than your 3.5. So now next step is we rank them. We rank them from the lowest to highest. So our rank 1 is going to be our call option, since it's 0. After that, it's going to be the convertible preferred shares. And then finally, the convertible bonds. So now that we set everything up, we can calculate our dilutive EPS. So we're going to have the income, the share, and the EPS. So the basic EPS, or the income, I'm going to put here, income available to common shareholders. So what we had here for the basic EPS was 1 million minus 125,000 of dividends. And then the number of shares were 250,000. So the EPS was 2.5. Then we go and we look at our rank 1, it was call option. Income available, no effect. And then the number of shares was 22,500. I'm going to sum the two together to see now what might be our new dilutive EPS. So you do the 875,000 divided by 272,000, and that gives us an EPS of 3.2. So it is dilutive because it's lower than our 3.5. Then we continue with our rank 2, which is the convertible preferred shares. The income available, so the increase in income was 125,000. And the share effect was plus 50,000. I'm going to sum again, but I'm just going to sum here, like what we already calculated, the 875,000 plus 125,000. That gives us 1 million. And then the number of shares are 50,000 plus 272,000. New EPS. 1 million divided by 322,500 is 3.1. Again, it is still dilutive because it's lower than the previous one that we calculated. Not, and also our basic EPS, but you have to look at the previous rank that you calculated. And then finally, our rank 3 is the convertible bonds. Our income effect was 450,000 and share effect was 150,000. You sum them together. And same here, I could just copy. And then you calculate your final dilutive EPS. So that's still lower than the one that we found previously. So it is still dilutive. So our dilutive EPS would have been $3.07 per share. You have to be careful when you're doing this calculation to look at if any here are increasing instead of lowering, of getting lower. Basically, if instead of getting 3.06 here, I would have gotten 3.2, then it would have become anti-dilutive. And your dilutive EPS in that case would have been the 3.1 that we found before, because this one increased our EPS. And all the following one, if there were more ranks, would have increased it too. So any question before I'm going to stop the recording?